All right. Good morning, everybody. This Friday. I did mention yesterday not to count Apple out. It has a history of doing the unexpected, that's for sure. I was already long from a trade that I'd been holding for a while, so I'm pleased with the outcome. But they did announce one of the biggest buybacks in history, and they also announced a double-digit revenue going forward. So markets seem to like that. Today we got non-farm payrolls, which means we have the opportunity for a liquidity gap. I love this trade setup. We get it multiple times a month. It is something that you can see intraday as well. And once we get through the numbers here, I will show examples of this trade setup and kind of explain it a little bit. Looking at what's going on around the world, Apple did move markets globally. Japan is down. The Russell's basically flat with the small caps. China's up almost 0.25%. S&P closer to a half. The Nasdaq closer to 3/4, and the Dow, which we were looking at yesterday, closer to 1%. Of course, if you look at the indexes, you have weighted versus unweighted indexes, and the Dow being different than the S&P and the Nasdaq feels the effects of Apple differently. So far, it is a really good Friday. I hope you guys have a good weekend planned. A friend of mine has a son whose birthday is being celebrated this weekend. So, not exactly the funnest thing to go to an 8-year-old's birthday party, but I do get to go hang out with my friends. So, good food, hopefully some good weather. Non-farm payrolls is one of the biggest job numbers that we can get. It very often develops into a liquidity gap trade setup. It's not the only thing we're going to be getting today, though. We also have ISM services. And next week, we're going to hear from a lot of feds. Looking at the impact gauge on FX Street, you can see we have a lot of high impact events today. We are going to get some Fed speakers tonight, but by then it won't matter anyways. So we can see U.S. market futures hinted additional rise. Wall Street, Europe's Stoic 600 gained 0.4%. Tech companies rallied. Pharmaceuticals lagged. If you've seen Nordisk falling, then you also have to think about, you know, uh, LLY and VKTX, right? You got to think about those uh, peers also getting hit. We got Baba, Walmart, Target, Nvidia from the 14th, 16th, and the 22nd. Just earnings that are still ahead. Apple's still got a really large market maker move, too. All right, the ES is looking at a market maker move this morning. They are hedging in front of non-farm payrolls. Generally, we would see a really low overnight volume when they're hedging, and that's what we have here. You can see we're looking at 50,000 in the cumulative overnight volume. So low volume coupled with market maker move tells us they're hedging and that they're worried about something. Now we know it's non-farm payrolls, so this isn't a surprise, but I point this out because if you ever come in the morning and you see low overnight volume with a market maker move and we don't have an economic agenda on the table, then you want to just call timeout right there and go find out why are they concerned? Why are they hedging? What's on the docket that you didn't know about, right? Because it can happen. There might be some kind of investors day event. There could be some global crisis starting to set up. You never know, right? That's the whole idea. These are warning signs. We don't need the warning today. We already knew it was non-farm payrolls. But if there hadn't been an economic event like non-farm and we've seen these two pieces of data, we would just really want to go hunt down what are they worried about? Why are they hedging? Of course, that's not an issue today. We know why they're hedging. If you're on a platform that does not have the market maker move, as long as you have access to options, you can see the market maker move for yourself. It's not a special tool. What we're looking for is the front series to be higher than the back series. So I'm just going to push these two numbers closer together so that you can see it easier this way. The front series is this 0 day right here. At some point, they're going to eliminate that. That was yesterday, so just ignore it. The front series is the 0 day. The next series out is Monday. The front series is higher than the next series out on the implied volatility average. And because of that, we have a market maker move. So even if you are on a platform that doesn't have a market maker move, as long as you have options data, then you have implied volatility average. It may not be on the side. You know, I've looked at Fidelity, Schwab, IBKR, Tasty Trade, ROJ Futures. I mean, you never know where this implied volatility is going to be, but it will be with the options somewhere. So if you have options, you have implied volatility average, and that's how you find a market maker move. It is a very distinct and clear signal that they're hedging. It's not my opinion. I'm not guessing. I'm not making assumptions. They're hedging. They're concerned. A hedge for retail is not that bad. A lot of times we can actually turn a hedge into a trade, which is pretty cool. But when it comes to trying to protect a very large portfolio, it's cost. Pure and simple, they're spending money to protect their position, and they won't spend money unless they're concerned, right? For them, it's not a trade. It's not income. It's not a way to profit. It's just protection. The analogy that I use is having a house fire insurance. You spend money on house fire insurance, not looking for a profit, but because you're trying to cover something. And no matter how much insurance you have, it's never going to really cover your house, right? There's just irreplaceable things that are in that house that you don't want to lose. So it'll help, but it won't keep you whole. And that's the same thing with hedging with these big firms. It'll help, but it won't keep them whole. And even if they don't end up using it, the cost is just like us paying the cost on that insurance. So when we see them hedging, we know that they're concerned and they're willing to actually spend money because of that concern. We have an MDP. It's a missed daily pivot. It means we have not come down and hit this pivot yet. It doesn't count for today. It actually counts tomorrow. MDPs always count for the next day. This is a strategy that's tradable, although I don't trade it myself, but I do use it in analysis, as I do with a lot of strategies. It's not mine to teach you. If you want to know more about missed daily pivots, you can always just go to Google or YouTube, type in missed daily pivots. You'll hear all about it. it does provide insight. Markets hit that pivot point 80% of the time. So when we don't hit it in the entire 24-hour trading period, the next day, that has some impact to it. So I mentioned a liquidity gap. These are some examples of a liquidity gap. I'll show you some good ones, what we're looking for, and then I'll also show you some bad ones, things that we don't want to see. So in a liquidity gap, this is an 831. It could have been non-farm payrolls. It might have been CPI, PPI. It's one of those. It's one of the 830 economic events. And we get a single directional push. Notice there's really no wick across the top side of this thing, right? The 830 data came out and it moved in a singular direction. Then we built a bit of a base and we worked our way back up to where we were at 830 and we got there around 11 o'clock. That is the entire idea right there. If we had marked out the halfback, you would notice that we did pause around that halfback and got rejected. It had to fight to get through that zone, and we finally got there around 11. Those are two important points that I always want to point out. Now, it didn't have to stop at the first candle. It could have kept going and built multiple candles in the same direction first before it turned around. That's okay too. We just don't want to have the original candle close more than halfway back from where it started. So if we were marking out a halfback here, this candle, we don't want it to set a really long wick and then come back up and close anywhere near that 50%. We certainly don't want it to close on the other side of the 50%. The closer to the end of the candle, the better. It doesn't have to be bearish. It can be bearish or bullish. Liquidity gaps like this can be intraday, after hours, blowbacks. I mean, they can happen anywhere. Equities, there's no limitations to this. And we see it all the time, right? Any big candle can be considered a liquidity gap. This is a different one, different day, different event, still an 830 print. Single directional push, spent the morning working its way back down. If we were to mark out the halfback, we did get a pause there. It worked its way through and actually buzzbeat off the other side. Got the gap closed a little sooner than 11, but at 11 o'clock, we actually got that drop base rally signal too. So I do like that on the time frame. Here's one that was actually a CPI. We know that because I wrote that one down. Multiple candles in a single direction. It did pull back a little bit, and notice how in the next candle it struggled. It actually stayed in that range or zone as if the wick area itself was a channel or an area that it had to struggle to get through. But it did get through there and it did continue a move to the upside. Then it based and worked its way back down. Notice we didn't really get a good, clean, clear halfback struggle. When it did start breaking down, it broke through the halfback as if there wasn't a halfback. But if we look farther down on that very first candle and consider where the halfback would have been on this candle, we found a halfback there. We got the gap closed around 11 o'clock. You know, I say all the time, watch the clock. And people always ask me, you know, what's that mean? As if there's some subtle secret little thing to what I'm saying. And I'm literally telling you, look at your watch, look at the clock. What time is it? This is what we don't want. So this was a non-farm payroll from February 9th. And you can see very large wick here. There was also some wick on the bottom but it was the top part of this wick that really gave warning that it wasn't what we were looking for. I don't want it to close anywhere near that 50%, and I don't want that big of a pullback. Now, it got the gap closed, and it got that gap closed really fast. That's another thing I don't want. Not interested in that. So if we don't get this set up, or if we get a setup that's sloppy like this, it doesn't mean that I'm not going to trade at all. It just means I'm not going to trade this strategy, this gap close play. I'll find some other way to trade whatever we're getting. Here's another example of what we do not want: big wicks in either direction. We get that, there is no gap close play. I don't want it. I'll do something else with it. Keep in mind, these really big candles can become analysis candles that we can snap our quadrant lines on that and mark 50% higher and 50% lower, 100% higher and 100% lower. And if we measured this, that was the stalling point here. Markets went 50% above that analysis candle and stalled out, couldn't make it through there. Another example of what we do not want: big wicks on each side. And I don't care if it's a red candle or a green candle. I don't want these big wicks in either direction. Again, we can use this analysis candle and we can snap quadrant lines from it. And that would be very likely 50% if we were to snap a quad line there. Again, another example. This is not what we want. I've always found it really helpful to show people what we do want, but also to give very clear examples of what we do not want. So if it seems like I'm just, repeating myself and banging on the table, yes, I've found that it helps if I just keep telling people the same thing over and over and over until it finally sinks in. This was a liquidity gap that came in at 10 o'clock, showing that this doesn't have to be, 8:30 only. It doesn't have to be pre-market or after hours. You can find these all over the place. There was one at 10 o'clock. There was another one here at 12:30. Both of those could and are considered liquidity gaps. Here's another one again at 3 o'clock in the afternoon. And every one of these had a gap close. Some took longer than others, but every one of these saw price come right back up to the gap close. And instantly got rejected on every one of them too. It rejected as soon as it got back up there. It rejected here as soon as it got back up there. And this one actually ran it over, but look at that wick. It did pull back. It was rejected when it got back down there. Liquidity resides on the other side of the pivot, so keep that in mind. The biggest one here in this picture was down here. This is the biggest one out of the whole thing. It makes sense that when we came down, it went through the pivot, that it went not just to the gap close, but onto the other side of it, because liquidity resides on the other side. So yesterday's high, low, close, gap close, starting point, it doesn't matter what the pivot is, liquidity is on the other side. We have this opportunity today, kind of the whole idea, right? That's why I'm pointing it out. We have non-farm payrolls today, and that is one of the opportunities that can present us with this setup. So the ADR lines, we're basically in the middle of them right now. Once we get non-farm payroll, we're very likely going to make a move, but because they've hedged it, it's also very likely that we won't continue to move in a single direction too far. You guys ever had that situation where, like, for the whole week, everybody's talking out an event, talking about, oh, it's going to be such a big event. This is market moving. It's going to mean so much to the market to get this information. We're probably going to get really bullish from here or really bearish. And it gets hyped up more and more and more and more. And then when the final day comes and the event gets there, it ends up exactly being a whole bunch of nothing. And it wasn't because it wasn't nothing, it was because it got hedged so much that the market never really responded to it at all. What moves markets, right? It's just the most fundamental question out there. Markets don't want to be surprised. If they're caught off sides and they're surprised, then they're all scrambling to do something all at once. They're all trying to sell, they're all trying to buy. That moves markets. But if you're hedged to the eyeballs and you don't care if it goes up and you don't care if it goes down, because either direction isn't going to bother you, then nobody's scrambling to buy or sell. Nobody's caught off sides, and then we don't get that big move. Or we get the big move and it just gets unwound again, kind of like this move that we had over here, right? With the FOMC day. It won't be so pronounced as that, but that's kind of the idea behind it. The algos will take the news and things will gyrate a little bit. But if everybody's hedged up, then it's just really going to end up being nothing. And it'll come back and reset. Now we can get that big candle that I was showing, that 830 print where we get the big move and then never come back and close the gap. The gap close is not guaranteed. So I always want to point that out, because even if we do get the setup, there's no guarantee that we're actually going to turn around and come back and get that gap closed today. We could just continue to drive in the direction of whatever the gap was, right? Bullish or bearish. So we want to see signals that it's actually starting to turn around and come back in the other direction, right? We want to see it building that base or that topping pattern. Not all of these, really built that base or that topping pattern. This one did. It did a reasonably good job showing that it was done going down, building that base, working on its way back up, struggling with the half back. There was structure and context here. That's what we want to see. So, you're going to see at some point sooner or later where you get one of these really big candles, you're expecting the liquidity gap, and it just keeps on going. It happens. This one really didn't build a base or any sort of a topping pattern at all. It just immediately started working on getting that gap closed. It still had structure to it. It stopped at the half back. It showed that it was respecting pivots and levels. So all good. So they're not always really clear or simple or easy to grasp the logic of. And just because we get one does not guarantee that we're going to get the gap closed. And hedging is going to be a big part of whether or not the market gets this really big move. So we're still inside week. Like to see this resolved today, one way or the other. And I don't think it's out of line to consider either side being breached. We've got a market maker move of $37 or 37 points. We've got a 21-day average daily range of 73 points. So this is well over 100 points. Look at where we are at. Consider a move of 100 points. And we're just using some simple rounding here. 100 points would get us 5,200 to the upside. And it would get us to the bottom of the previous week alone right there. So we can easily make an inside week breakout up or down, and it wouldn't be considered out of line. We're not even stretching at this point. We would need like a 2 standard deviation move to begin to consider an outsize move. If we're done with this pullback and we're going to start working our way back up and get through 5,300 and continue to that advance to the upside, then the market really needs to show its hand here and, get a little bulled up. So a nice start to that would be getting this inside week breakout. Even if we don't, it doesn't immediately make us bearish, but I would begin to focus more on the halfback if that's the case. 50.76 would be that halfback level. If we close above that on the week, then we can pretty much keep our neutral bias or even a slightly bullish bias. But if we close below that halfback, then it really does begin to set us up for a more bearish posture. We'd look to challenge that 20-week again, maybe get that inside week breakout to the downside next week and start working through these lower levels, getting below 5,000 and really beginning to expand lower. So a tell for being more bearish would be closing under that 50.76 on the week. If we look at all this on a daily, it's still just a complex topping pattern. We do have our lower high set, but at the moment we have a higher low set. Now, some analysts are going to argue that this isn't enough of a pullback. You know, it's one single candle, that we need more. So if that argument is to be made, then we can consider that we need a deeper move down to consider a lower high or a higher high, higher low. When you run into a situation like this where you're trying to argue whether or not that is a deep enough pullback, there is a strange little indicator out there called the zigzag. And with that indicator, you can set a measurement on how far each leg has to pull back or run higher before it's considered a true pullback or a new leg up. Something to think about if you are trying to find some guidelines for yourself on how deep of a move you have to have before it's considered a true pullback or not. Either way, our boundaries are clear. We have to break this low, this 50-50, just to use some round numbers. We need to break that on a daily to challenge this low under that 5,000, and or we got to get above 51.50, challenge that 50, the 50 period moving average, and begin working our way back up. So if we get some kind of big blowout move today that really just changes the narrative, which Apple, you know, if you are catching the headlines already, Apple is already starting to change the narrative. They were picking it up a little bit on Finance Juice on how Apple changed the narrative with tech stocks. That's not the one. But if the market is starting to look at tech stocks differently because of Apple, then that would be a part of the whole Magnificent Seven coming back up, and there it is. Apple fueled the confidence about the profit potential of large technology companies. That would be changing the narrative. So then you look at your growth versus value ratio chart and the Mag 7 chart. Look for semiconductors and communications names, consumer discretionary, and start to see everything turn back around. For this morning, the pivot points won't matter until after non-farm payroll. So whatever big move we're going to get, that gyration that we see at 8:30 when we get the data, it will run through whatever pivot points it wants to run through. They won't contain it. So, you know, if you are just starting to get into pivot points and you're focusing on things like yesterday's high, low, close, floor pivots, value area highs and lows from volume profiles, point of controls, none of that stuff will affect where price goes during the non-farm payroll push. Now, after that initial push, when the algos start to settle down, then sure, yeah, measured moves and pivot points, they'll all come back into play. But none of those will affect how far price moves when we first get the data. We are back above the volatility trigger and zero gamma for the moment. And we are still underneath a lot of moving averages like the 20-day, the 10-week, the 3-week, but we are above the 10-day moving average for the moment. we're bullish above the weekly pivot point. We're bullish above a daily pivot point. Just keep in mind, like I've shown when it comes to pivot points, the idea of an R1 for an S2 or a S1 for an R2. So if we just, wipe all this stuff out here. SVE on Thinkorswim is a floor pivot. So I just applied floor pivots here. The pivot is in purple. The S levels are in green. The R levels are in red. We can very easily get an R1, which is where we pop to the upside and hit that R level, and then drop to an S2. It's actually a tradable strategy or a setup. And if you look back in the past, you'll see examples of that kind of behavior where we get an S1 and an R2 or an R1 and an S2. Not really seen any examples of it in that bit of a pullback, but it's been a weird week anyways with QRA and FOMC and everything else that's been on the table. Still, with us holding above the daily pivot point, that puts us closer to an R1 than it would to an S1. If we're going to get that kind of combo, it would make more sense that we reject off the first R level and drop through in 2 S levels. We don't have to, of course. We can go right through the first R and into the second and third. But if we're going to make that kind of move to the upside and not close the gap, then I would just continue to focus on my own pivot points at that point. 51.31 is not only last week's close, it is also a cog line COG. And the previous week's high is also where the lower ADR is today. So we have multiple pivot points or areas of interest stacked on top of each other. So much resistance and support in either direction, all these lines and levels, and we're just trapped by all these zones. It's almost like we need a flush, right? We need a washout, and washouts can be from crashing up just as easily as crashing down. Ten-day, 30-minute volume profile. Throughout the day today, unless we break 50.22, we're going to lose the lows. I'll just tighten this up a little bit. And we'll have a much tighter range. So we got to get outside this box, 51.50 to the upside, or just call it 5,000 to the downside. Otherwise, we're going to just continue to stay here in the middle, build out more of that classic D shape. We can see that the TPO, the profile here in blue, has moved the point of control all the way to the top. It won't surprise if we stay where we are a little bit longer, right around this 5100 area, to see the blue point of control move down to our new location. But at the moment, it's still sitting up at the highs. I always loved looking at this on a 5-day, 5-minute with the profile like that, because it really highlights how restrictive and contained we are this morning. This is a classic example of a very narrow IB, initial balance. The IB is like an open range. The difference is if it's an open range, we can choose whatever time frame we want. 5-minute open range, 15, 30, 1 hour. It's open range, we can do whatever we want. But an initial balance is 1 hour. That's just what it is. It's what it's supposed to be. We don't get to choose. It just is a 1 hour open range. When we have a very narrow IB like this, it implies that there's still work to be done, a lot of unfinished business. They haven't yet come in and got their trading done, and that they still have the reserve and can come in and trade. That's not a surprise for us this morning. Who would want to trade in front of a really big event with a very large position? Why not just wait for the event, and once you get the data, then trade your position? So it's not a surprise that we're seeing this hurry up and wait mode. But if we didn't know, just like we talked about earlier, coming into a market one morning and just finding a very narrow IB like this without some economic schedule, you would want to be concerned and find out, why are we so tightly wound sideways and what are they waiting on? So it's just another signal or a warning. We did hit this 50-53 VPOC, so we don't need it anymore. We're just going to carry that line over to the new point of control that we made yesterday. $50.64. I believe we still have a number of profiles. We're just building them up a little bit at a time. When we finally do make moves to the downside again, these will be here. I have to say, though, over the years, I've gotten to the point where if the VPOC is from a time period that is from an old contract series, say, here's the contract change, and these are all from that old contract change. To me, these don't have any value or weight anymore. I still have them on there. I'm a little bit of a nerd. I want to see, if or when price goes back down there, how it responds at those levels. But since they're an old contract, there's no quote unfinished business there, right? They can't still have that position. It's gone. So there wouldn't be, trades left behind, unfinished business, anything like that. They're all gone. This is the other contract change. And so we could consider that all of these are gone. But again, like I said, I'm keeping my eye on them anyways, just because I'm a bit of a nerd. But to me, that logic makes sense. Those VPOC levels can't represent trapped traders, unfinished business, anything like that, because those contracts are gone. But if you were doing equities, right, this was shares on Apple or Google, whatever, you wouldn't have to worry about contract change events and expired positions, anything like that. You would want to carry those VPOCs forward until you had a reason to believe that liquidity wasn't there anymore. We do have the new week. It's not set in stone yet. This is just a reflection of what it could be. Do this every Friday, taking a look at the amount of volatility they're pricing into next week's market. Now, since it's not set in stone, this is just a glimpse of what it could be next week. As the day goes by, next week's box is going to continue to move up and down with price. And at 4:15 this afternoon, it will lock into place and then it won't move anymore. But we can take a measure of our current week and set it on to next week and look at the volatility there. Next week's range is smaller than the current week's range, which implies they're reducing the volatility. Yeah, probably this afternoon, right? Yeah. Let's do that this afternoon. Thinkorswim's the only one that calls that SVE, by the way, which is just crazy confusing. I don't know why they couldn't have just called it a floor pivot like everybody else. But yeah, we'll go into that. So they are reducing volatility. We can see that, and that makes sense. Um, we've gotten through some of the biggest economic events, including some of the biggest earnings. And so it's not a surprise to see that next week's range is a little bit smaller. We are back inside the box for the current week. We talked about this earlier where we had broke out of the box and that we expect to close inside the box at least 80% of the time on the S&P. If it was anything else, we'd expect to close inside the box at least 70% of the time since it's a one standard deviation. This is also day 3. If you've heard me talk about the door day 1 open range or a 3-day open range, then this is the 3rd day, but this day needs to close for it to be valid. That white bar right there is the first day of the month. If we were using a day 1 open range, then that would be the open range bar that we would use. I'm still on the fence about how useful open range strategies are on the futures as opposed to on equities. It's an older trade setup. I've been studying open range for years, and I was just really surprised when I found opening range strategies for daily and weekly charts. Blew my mind. We're all so focused on short duration trading strategies that, a strategy from back when people were still using 15-minute delayed data on dial up and it cost them, $1,000 a month to have that data and they were happy for it. I don't miss those days. I'm glad I wasn't a trader in those days. But these kind of strategies, like a day 1 open range, it's an older strategy that used daily levels for open ranges. But so far, when it comes to futures, I haven't found much value from that daily open range strategy. Equities, on the other hand, still have a lot of work to do on those, but I like it. And it is very similar to anchored VWAP on the logic of using those higher time frames with a set period in time. And an anchored VWAP, right, can be anchored from biggest gap, largest volume, a new month, new quarter, an earnings event. We can anchor VWAP for all kinds of reasons. So why not have open ranges in different locations like daily, weekly? Who'd have thought, right? Plus, there are strategies that focus on first day of the month or first week of the month. They kind of get overshadowed by all these modern tools and different tactics, but those classic old school strategies, they still work. So at the end of the day, we will have our 3rd day for the 3-day open range. We are back above the 0 line. We're just crisscrossing that 10 at this point. We really want to expand away from it. And until we get that, we got to assume that we're just going to continue that dance back and forth. For the weekly, it's the same thing. We're just crisscrossing back and forth. So no matter how big of a move you think we've had so far this week, we haven't gone anywhere. We haven't done anything. We have 15 minutes before the non-farm payrolls gets here today. There's no reason to really look at equities, dig through what's up this morning and what's down this morning and who's gapped and whatever. None of that is going to stick. If it's up and non-farm payroll takes the market down, then everything's going to go down. And if they're down, but non-farm payrolls pushes the market up, then anything that was down is going to flip up. So there's no reason to even dig through. What you're going to want to do is after we get non-farm payroll, then you can go and look at equities probably around 9 o'clock, right? We'd have enough time at that point to see what equities are going to do with the data that we get and how the dollar and the 10-year are moving, because they're going to be the clue that really kind of highlights for us what equities are going to do. That way, if you're not trading the futures, but you're instead trading the equities, then you'll have an idea of what we're going to be looking for. This is the 3-pane setup that Finance Juice uses when it comes to reporting economic events like non-farm payroll or that sort of thing. They often post this one on their website. You got the 2-year on the right, the Dixie on the left, and the ES in the middle, because of course the SPX isn't going to move until 9:30. So we need something in the middle. When we get that first initial push, say it's an upside move in the ES, we want to watch what the dollar and the 10-year do. If that upside move is true and it's going to stick, then we're going to see the dollar and the 10-year continue to move lower. Otherwise, if they initially move lower and then flip, it's very likely that the S&P is going to continue that upside move. Same thing if the S&P goes down, we're going to be expecting the 10-year and the Dixie to go up. If we're looking for that gap close, we'll expect the Dixie and the 10-year after it goes up to start to fade, and we'd expect the ES to flip around and start going back up. There is a little bit of a tell. This thing's already starting to make a move. Now, that could be a false flag. It could be a lot of different reasons that it's already breaking down. But if you were watching that on Wednesday, right before the announcement, it started to break down then too. So there's times where you'll see this give a little early warning of the direction. If this is true and it's not a false flag, then it looks like they are anticipating non-farm payrolls popping the market higher. It'd be nice to see 5,200 by the end of the day, huh? It'd be a nice run. So a decent little tool to use, right? Pair that 2-year with the Dixie on event days like this, and can that way you're not just looking at one market like the ES or the NASDAQ and trying to see if that reversal is true, if it's really going to come back. But you should see inverse relationship. If the ES is going up, the 2-year and the Dixie should go down. If there's any sort of reversal in the ES and it's trying to go back into the other direction, we should also see reversals in the 10-year and the dollar, or the 2-year in this case. I'll leave you guys with that. You got about 12 minutes before non-farm payrolls. Hope you all have a good weekend.